Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Back again for another one, Bills.
Mate, we are back and we've got a ripping episode for our listeners today, mate. What are we talking about?
Yeah, today we're talking all about margin loans. So a topic that we've touched on a little bit in the past. We've spoken about using debt to invest, but nothing is as specific about margin loans as to the detail that we're about to go through in this episode.
Pretty exciting strategy and you need a financial product out of the back of it. But this strategy really gets me excited because, and you'll get an understanding why when we sort of delve into it a little bit deeper. But from an investing perspective, it really gives investors the opportunity to take their position and turn it into something different if done correctly. So yeah, let's get straight into it. Let's get cracking and get some value into the ears of our listeners, and away we go. Andrew, lead us in. What is a margin loan?
Yeah, so look, a margin loan is really it's a product that allows you to use debt against a portfolio of usually shares and managed funds. So you've got a portfolio of shares and managed funds, allows you to use that portfolio as security, take out debt essentially that's limited to that portfolio, and use that to invest back into the portfolio.
So essentially what we're doing is ordinarily share or managed fund portfolio using, I'll call it ordinary money, but using your own money, your own cash flow, your own savings, your own surplus, and then coupling that with a debt product. So borrowing against the portfolio itself and using that to invest. So not only using your own money, but you're also adding some leverage to the portfolio to be able to increase your position in the security, the shares or the managed funds that you're taking.
Yeah. I mean, look, you kind of compare and contrast it to, most people understand you buy an investment property. So when you buy an investment property, you use a portion of your own funds and a portion of the bank's funds. Most of the time, I don't know many people that can buy an investment property without taking on any debt. This operates in a similar manner in which you take out funds or you use your own funds as well as a portion of the bank's funds. The only difference is rather than investing in a property, you're investing in a portfolio of shares and managed funds.
Yeah, real simple, great explanation. I guess the thing to point out, which is pretty obvious, but we'll call it anyway. When you do buy that property, and I know we've spoken about property a fair bit recently, but when you do buy property, it's a long-term asset. It's a long-term holding for various reasons, usually leveraging anywhere from 80% potentially upwards. And that's a generalization, but there's a lot of debt associated with that. But the key difference between these two, I think, is with your property, you can't actually test the value of that property. Okay, you've got a rough idea, but unless you put it to market, take it to auction or private sale and actually see what the market's doing. Whereas with a portfolio of shares or managed funds, whenever the markets are open, you can get the exact portfolio value at that particular point in time. So we'll talk about this a little bit of more detail later on, but you need a particular type of investor appetite to invest in this because you can see the portfolio value all the time. And if we're experiencing a period of volatility, you really need to stay invested, like all investments, but it's different to what you're describing just by its very nature that you can get an up-to-date portfolio valuation pretty much in real time at any particular point in time during the trading week.
Yeah, which is really, I mean, look, it's a benefit to some investors because you're getting an accurate valuation of your portfolio on a almost second-by-second basis, but to other investors and probably psychologically, it's to its own detriment because you're able to track and see that valuation every day and all the time. I mean, a lot of the conversations that we're having, and this is a little bit off on a tangent, but similar vein to what we're talking about, is when you're talking to clients that are looking to invest, generally speaking, what we tend to see is clients have an appetite for property, they have an appetite to purchase property, and they see it as more secure and less risky. When you're taking on significant amount of risk, irrespective in whatever you invest in. The only difference is with property, you're not getting a real-time valuation. And so you're not seeing those fluctuations happening every minute of every day. And so it's kind of out of mind and out of sight. Whereas in a portfolio of shares and managed funds, you're getting that real-time feedback. You're seeing those fluctuations happening all the time. And so the perception around it is that it's a riskier investment just because you're seeing those swings happen all the time.
Yeah. And that can't be downplayed. We'll talk about some of the risk mitigation strategies later on, and the appetite around the type of investor that it takes to do this, I think, is critical. Some of the things that we need to take into consideration with this strategy, obviously you need the cash flow in order to fund, you are taking on debt, so you need to be able to fund the interest repayments. From an interest rate perspective, it doesn't work the same way as a property. Interest rates are higher. I mean, look, from a home loan perspective, we're getting, generally speaking, somewhere between 1.5% to 2% on a variable rate. With a margin lending product, we're seeing around, I don't know, Andrew, what are we seeing? 4.5%, 5%, depending on the amount borrowed?
Depending on the amount borrowed, depending on which margin lender you're going with. But yeah, you're really looking at sort of the bottom end of it is 4.5%, and you're even seeing margin loan interest rates up and above 6% at times as well.
And it'll be interesting to see with an increasing interest rate environment, what's going to happen to these types of rates. I mean, obviously the property mortgage rates are the headline ones that you see in the media, but I suspect that these will increase as well too. So making sure that from a cash flow perspective, we can cover the interest rate payable. The underlying asset should be producing some income that goes towards servicing itself as well anyway. So that's one of the considerations, the interest rate and the interest repayments that we need to take into account. Probably the biggest thing that's the issue not the issue, but the thing to consider from a risk mitigation perspective is margin calls and how a margin lending facility works in the event that the portfolio value drops beneath a certain level. You do trigger a margin call. This is probably the biggest thing that we need to plan for when we're recommending it to clients with some of the risk mitigation strategies that we put in place. But Andrew, let's run through it. Talk us through what a margin call is, and it should become pretty obvious why we want to avoid those at all costs. But talk us through what a margin call is, because that's probably the biggest distinguishing feature, I think, with a margin lending facility that we need to call out for our listeners.
Yeah. Again, sort of bringing it back to property side of things, just to compare and contrast. If you buy a property and you're buying it an LVR of, let's say, 80%, right? So LVR is the amount of money that you've contributed towards it, or the debt in relation to the value of the asset. So at an 80% LVR, the debt is 80% of the asset's overall value. Now, you purchase a property and let's say the property market plummets the next day. So now when you purchase the property, the LVR was 80%, but you might be at 90% or 95% because the value of the property has now gone down while your debt position has still remained the same. Now, in a property scenario, as long as you continue to make repayments, then the bank doesn't really care about your LVR position unless you're looking to refinance or anything like that.
We hope so.
Yeah, we hope so.
Home loans are still at call, so the bank can call it in whenever they want, right?
True, but I mean,
we haven't seen it. We haven't seen it.
So it's one of those things that you're talking about a doomsday scenario here. But in contrast to that, when you purchase or when you take out a margin loan, now various margin lenders will have different limits in terms of when they experience margin calls. A lot of the times that sits around 75, 80% around that mark. But let's say you enter into a margin loan facility and the LVR is at 60%. So 60% of your overall portfolio is the debt value. If the market drops and if the market starts to approach that LVR where the margin call can be made by the loan facilitator, they can and will instruct you to do either one of two things. Either sell a portion of your assets in order to reduce the LVR and bring yourself back to an acceptable LVR, or add additional funds into the portfolio so that your LVR again can be dropped and go back to an acceptable level. So irrespective of whether home loan, as long as you make your repayments, no issues, continue to make your repayments and it should be okay. Margin loan, irrespective of whether you're making your repayments, if the value of the portfolio drops and your LVR increases to an unacceptable point, then the margin lender has the ability to bring the LVR back up.
So essentially, in a really simplistic nutshell, it comes down to the lender managing their security position against the debt that you've got. And they've got predetermined thresholds around what they deem comfortable. And I guess the reason that a margin lending facility is different to other debt facilities is you can experience in a volatile market, you can see portfolio values drop. And we'll go back to the first sort of round of COVID that had its impact on investment markets. So we're talking March of 2020, when the investment markets realized that, hey, COVID's going to be a bigger issue than what we had expected. Over that period of March through April, we saw investment markets drop by 30%. Okay, they rebounded extremely quickly and stuff, but from a margin lending perspective, we can see portfolio values in the, I guess we'll call it the right type of market, drop quite significantly. And the margin lenders want to make sure that their security positions are sound because markets can drop so quickly. So when markets are volatile, when we are experiencing a downturn in the market, the lenders have these predetermined thresholds to be able to maintain enough security to make sure that they're covered from a lending perspective.
Yeah, and that represents a significant amount of risk. I mean, if you're an investor and whether you've just started investing or whether you're an experienced investor, most of the time, or most people will understand that you don't want to be selling at a low. So most of the time when the market's dropping, that's the time that you want to hold on. And if you've got opportunity to buy in at depleted prices, then fantastic. But you don't want to be selling the bottom of the market. Now, if you're in a margin loan facility, yes, you can have the foresight and you can have the investor understanding of, you know what, I need to just hold on and I need to wait for markets to recover. But if you don't have the ability to add money to the portfolio and bring your LVR to an acceptable level, the margin lender can and will take over and will sell down the assets on your behalf, irrespective of whether you're making repayments on your margin loan facility. So margin call is a fairly significant thing, and there has to be a risk mitigation strategy so that you're not, even though you might have the best mindset, even though you might have the best strategy, you're basically forced in a position where you don't have a choice.
Yep. Yeah, so not only is your asset value potentially going down, but the debt that you've got is not going anywhere. And then you're in a position that if you don't act accordingly, then the rug can get pulled from under you and the margin lending facility can take over the shares and sell them without you. Basically, you have no say, you have no input, right? So, well, if that's the case, I mean, let's talk about some of the positives associated with
because we're making a pretty doom and gloom, aren't we?
But look, there's the pretty, and we've touched on this recently in another podcast, but using leverage in order to get into any type of investment, generally, when we apply that to a property sense, is generally the only way to go. With a portfolio of shares or managed funds, it allows you to increase your holding in your position. So in the event that you've got an absolute gain, the absolute gain is bigger. Essentially, what I'm trying to say is that it magnifies your gains.
Exactly right. Like any debt or leverage on any investment, it's going to magnify your gains.
Allows increased diversification as well because you've got more money to be able to spread amongst different types of asset classes when you are investing. And I guess the other one that's also a big one, and if done properly, it can also help from a cash flow perspective, is the tax deductibility of the interest associated with it. So not that long ago, we were talking about property and using the negatively geared aspect of a property to be able to help fund the cash flow shortfall from a margin lending facility. If you do have the right types of assets sitting in there that are generating a decent enough income, yes, the interest is tax deductible, but also the income that's being derived off those assets can help support the loan facility as well too.
Yeah, exactly right. Exactly right. And I think, I mean, and this probably feeds into one of the other things that we wanted to discuss as well around why you'd use a margin loan facility as opposed to another debt facility. But the other thing that it also does is you can protect the equity that you have in your investment property or owner-occupied property. So you consider a client now, you're obviously taking on a significant amount of risk, and so you need to make sure that there's some risk mitigation strategies in there as well. But if someone has the intention of upgrading their family home, you may not want to draw equity out of your family home in order to invest in a portfolio of shares and managed funds. And so what you do is you protect that equity, leave the equity in your family home, take on a margin loan facility, whereby you're not utilizing your already available equity because you've got another reason or another purpose for that equity at a future point in time. So you can utilize a different lending facility so that you're protecting the equity that you've got in either your family home or existing investment property as well.
Yeah, and I guess the other thing with that is you also need the equity to be able to do that. So if you've got plenty of equity, that could be a consideration. And we'll talk about that in a sec. But if you don't, or if you don't want to, then yeah, that's what these facilities are for. So Andrew, we spoke a little bit about the pros of this type of strategy. We did talk a little bit about the cons, but I think there's probably 2 or 3 that we need to call out. From my perspective, we spoke about the ability to magnify gains, but also that works in reverse as well, and we can magnify losses. So I think that one's pretty straightforward, just something to be aware of. And that sort of plays into 2 things: how quickly investment markets can turn, and also if we are approaching margin call territory. So the margin call is probably the second one. What about rising interest rates?
Yeah, so obviously, whenever you're considering an investment, you really need to consider the net position. It's not just about how much you're getting out of the investment, it's how much it's costing you to either buy in or continue to maintain that investment facility. So as interest rates increase, what obviously happens is the expense associated with a margin loan also increases. So yes, a margin loan may be feasible at day one, and you might say, yep, fantastic, I can afford to make the repayments and I can afford to engage in this type of facility. However, what you need to do is also look at, okay, what if interest rates do rise? What impact is a 1% or a 2% or even a 3% interest rate rise going to have on the net position of the portfolio, but then in addition to that, your own expense in terms of maintaining that facility as well. So you do have the risk of interest rates rising, impacting the cash flow and the net rate of return of the investment.
Just gives you more deductibility, doesn't it?
I think all of our listeners should by now know that tax deduction is not just the only name of the game as some people may think.
You don't get into an investment just because the interest is tax deductible, right? Yeah. Plain and simple.
Exactly.
So why would we use a margin loan if we've got equity in our property? I mean, you touched on it a little bit before, but just because the interest rate is higher with more deductibility, is it because you don't have equity? Sorry, you don't want to use equity in your property? I mean, what are some of the things that we'd be looking at from that perspective?
So look, it's a couple of things. I mean, if you've got equity in your property, you need to decide on, if you're going to, what's the purpose of that equity for? Are you going to utilize that to upgrade your family home? Are you going to utilize that to buy another investment property? Are you going to utilize that equity for another purpose? So one of the reasons is to protect that equity. Or if you don't have equity, a margin loan allows people to, even though you haven't built equity in your properties, you may still want to use leveraging for a margin call facility. And not everyone has a property. I mean, a lot of investors, there's obviously a movement around, there's rent vesting, there's people that just aren't comfortable or don't like the property market or want to be engaged in a property market investment. So this facility also allows people that's not investing in property to be able to still use leverage and still use debt in order to be able to expand and grow their wealth.
I guess the other thing, and I've always enjoyed this part about a share or a managed fund portfolio or any other asset that allows you to almost like snap off or break off smaller chunks. So for argument's sake, you wanted to spend some money on something, you can't sell your driveway. Yeah. Okay, you can borrow against your house and what have you, but that's a different thing altogether. But if you needed a smallish amount of money because you want to do something, you want to buy a car, I don't know what a good example is, you can sell a parcel of shares or part of your portfolio to be able to do that. It's not all or nothing the same way that, say, a property is. So that's one of the things that I've always sort of enjoyed about that as well too. I guess overlaying this with a financial planning aspect, Andrew, we're having these conversations with clients every day. We're talking to them about different strategies, talking to them about margin lending, the pros, the cons associated with it. As part of our role and making sure that we're doing this prudently, we're also putting some risk mitigation strategies together. It's not for everyone, but we go through a very, very, very detailed process around who it suits and also what boxes that they need to tick in order to make sure that, I guess, we're comfortable meeting our professional obligation, before we go and recommend this to a client. Let's talk about some of the risk mitigation strategies that we run through and we look at when we're talking to clients about this to make sure that it's appropriate and prudent for them and their circumstances.
Yeah, I mean, look, one of the first point calls that you look at is the LVR at the time that you're entering this position. So, if your at call is 80% on a margin loan and you don't want to be experiencing a margin call, then you're not going to leverage the portfolio at 75% because it's only going to need a small drop in the market for you to experience a margin call. And so what you're going to do is invest, and I'm not going to say all the time, but the vast majority of the time, when you're entering into a margin loan facility, you're entering at much lower LVRs than what you're doing when you're entering into, a property investment. So first point in call is make sure that your LVR is at an appropriate number, and also be careful around, and this is obviously one of the many reasons that I'm a big advocate for advice, but a margin, and this is maybe going into a little bit too much detail, but a lender in a margin loan doesn't look at just the value of the security that you're investing in particular with managed funds. So some managed funds, even though you might have $10,000 in that fund manager, the margin lender doesn't actually take the full value of the $10,000. They shade out 85% or a portion of it.
Or shade out 15%.
They
recognize 85%.
They recognize 85% and shade out a portion of it for various reasons. I mean, some of it is because the managed fund already has debt associated with their investments, but for a variety of reasons, you also need to be careful about the difference between what you see as the value and the difference between what the lender sees as the value as well. That'll impact the LVR fairly heavily.
From our perspective, when we're recommending these to clients, the loan to value ratio is fairly conservative anyway, and that's a deliberate risk mitigation technique. Probably the other one, and this is just a general thing when you're taking on any form of debt, I guess, but looking at your income security. So what I mean by that is, what do you do from an employment perspective? How secure is your employment? Because pretty straightforward, but you should not be taking on debt if there's any question marks around your employment security. So consistent income. And when we look across the household, obviously if there's multiple people involved in the household that have dual incomes, obviously that's a better position. It's probably no different to what we see from a lending perspective with a traditional mortgage broking product, where you've got a lender taking two borrowers with two incomes, so two people can service the loan. So consistency and security of income is definitely up there for me. Cash reserves, Andrew?
Yeah, I think that's another massive one, in particular in an environment where, or an asset that there's the possibility of a margin call. So you want to make sure that there's cash reserves aside so that if you do experience a margin call, or if something does happen in terms of the market and the particular assets that you're investing in, you want to make sure that there's an amount of money that's set aside that you know that you can pop straight in and not need to worry too much about having to liquidate the assets at a negative or a low valuation. So making sure that there's significant cash reserves in order to be able to facilitate, margin calls and any other sort of impacts that may happen as a result of loss of income, and moving on to sort of a similar topic, but injury or illness that prevents you from being able to generate and earn an income as well.
Good conduit, Andrew, because the next thing that I was going to talk about is insurance.
Yeah.
In particular, income protection, making sure that in the event that you can't work due to injury or illness, your income is protected, making sure that you're covered so you can still meet your requirements under the facility obligation that you've got. But from a broader perspective, obviously you need to make sure that your income comes in so you can still run your household and live your lifestyle. So insurance is always something that we look at as part of a risk mitigation strategy when it comes to margin lending.
And any financial plan, really.
Well, it's funny how it crosses across so many different areas, but yeah, absolutely. Any prudent financial plan takes insurance into consideration. For most of the people that we're dealing with, you do get to a stage at some point in time where you don't need the insurance. You can self-insure. Your assets are large enough to be able to do that. But generally speaking, it's always one of the boxes that we're addressing as part of this strategy, as well as having the right appetite from an investor perspective when it comes to investing in a product and a strategy like this. So having the time frame to invest, because you can't enter into this and it does cost a little bit to get into it because you obviously need advice. There's a bit of complexity to it. You don't enter into something like this with the intention that you're going to get out of it soon. You need a long time frame to invest because it does, like anything, it does take time for this thing to work and work properly. You've got to let the compounding take effect. So you need to have that from an investor perspective. You need to have the time frame, a long time frame, in order to deploy this particular strategy.
Yeah, absolutely. Absolutely. And you need to have tied in with that the tolerance to risk associated with it as well. If you're scared of your portfolio dropping by 2% and you can't sleep at night because you've seen that, then a margin loan is probably not the right thing for you, because at the end of the day, as we said, you're magnifying your gains, but you're also magnifying your losses. And your losses aren't only limited to the investments that you're putting in, but also the interest and debt that you're taking against that portfolio as well. So you really need to have a relatively high tolerance to risk in this kind of strategy. And tied in with that as well is you need to look at what type of investment you're actually investing in, because entering into a margin loan facility and investing in fixed income assets makes very little to no sense, because a fixed income asset is fairly heavily dependent on interest rates. And so a lot of the times the interest rate that you're getting on a fixed income investment is going to be less than what you're getting out of a margin loan. So yes, that might form part of the portfolio as a risk mitigation strategy, but if you don't have the tolerance to invest more heavily in growth assets than in defensive assets, then a margin loan facility is probably not really the right thing for you.
Well, your rate of return needs to be there. Otherwise, you're paying interest for no reason. So your rate of return needs to be high enough to be able to support the portfolio.
And you also need to be careful as well. Look, some people can do it deliberately, and it takes a fairly extreme investor and a fairly extreme, tolerance to risk. But double gearing, it's something that, yes, most people won't do it day one, but you can sometimes forget about it and it can creep into it. So think about the investor that, draws a bit of equity out of their either family home or investment property or whatever it is, but draw some equity out, puts it into a managed portfolio of, shares and managed funds. You kind of start to think that over the course of a number of years, this is just my money and I've put all of that money into it. And then you take out a margin loan against it. Now, all of a sudden, you've used equity and you've taken out debt against that equity as well. So you're double gearing. Now, some people can, and some investors will look at that deliberately, and they're willing to push the extreme end in terms of debt and gearing, and that might be the right strategy for them. But you do need to be careful about what's the actual source of the portfolio, and am I double gearing by taking on a margin lending facility? And if I am I willing to take on that risk that's associated with it as well?
I think you'd be hard pressed, Andrew, to find an advisor that would endorse that particular strategy. But you're right, it's quite a risky one, and we don't come across it too often at all. But if we do, we obviously talk through the client, run through the education piece associated with it. We never go down that path anyway, for all the reasons that you've just stated. But look, Andrew, I think we've done it some justice. So margin lending facility gives us the ability to get into an asset or expose us to an asset from a greater perspective, gives us the ability to magnify our gains. There is some risk associated with it, so we need to make sure that we've got, one, the right tolerance to be able to invest in this particular type of strategy, two, that we're aware of the risks associated with it, and three, we've got all of those boxes ticked from a risk mitigation point of view. But I guess from our point of view, we spoke a lot about the risk and the downside. From, just to end this thing on a positive note, from the upside, this is a really worthwhile strategy that we deploy for clients that meet all of the right criteria and have the right appetite for it. But this is a strategy from a wealth creation perspective, which sits at the core of what we do. This is something that can take a position of a client from, you can't actually see my hands because this is just an audio recording, but from here to here. So I'm moving my hands obviously up. But it's a really worthwhile and beneficial strategy if you get it right, if you get the strategy right, and if you manage the risks appropriately.
Yeah, absolutely. Absolutely. Well summarized, Bills. I would just want to, obviously take the time again to say thanks to everyone for listening. Thanks for jumping in on the 360 Money Matters podcast. If you want any additional information, not only on margin lending and this type of strategy, but anything in relation to wealth creation and financial planning, our details in the show notes. So thanks again for listening. Bills, thanks again for another podcast, and look forward to catching you on the next one.
Andrew, thank you, and we'll catch our listeners on the next one. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.